On this episode, we get to the bottom of what all the hype is around option trading. Welcome to episode 10 of Think at Heart. All right, episode 10. I'm Scott Goodfellow, and as always, this is Ben Hart, Hart Investment Group. And there's been a lot of hype around option trading all of a sudden, don't you think? Like, there's been, ever since GameStop, everybody has an opinion about and wants to know what is option trading, number one. And when you try to explain it, still nobody knows what it is, right? So we went out and we found an expert on it, right? And he is Ryan Marr. And Ben, why don't you take it away from there?
Okay, sounds good. Thanks, Scott. So yeah, I know further to what Scott's saying, there's been lots of questions about options for obviously clients that know me. I've run with option protection within portfolios, and what I've found over the years is that it really adds some stability to clients' portfolios. And what I found is there's not a lot of managers that actually truly manage an option strategy. And I've been working with Waypoint for the past year or so. They run a strategy that focuses almost exclusively on options. So Ryan's going to talk today, and I'm really excited to hear what he has to say. Not too many people want to get into the weeds and talk about options, so I'm excited about that part. And Ryan, maybe you can tell us a little bit about yourself. Tell me a little bit about, I know we had a good chat offline before we started recording. Maybe you can give me some details, and then we can dive in.
Sure. So I'm Ryan Marr. I'm a portfolio manager in Canada, focused on Canadian equities as well as Canadian options, being both put and call options on Canadian equities traded on the Montreal Exchange. I've been involved in that market for well over a decade, and run a strategy that focuses on that asset class, being volatility. It's not something that is commonly understood in Canada, but happy to provide as much detail as I can to help educate the listeners.
Awesome.
Well, I'll tell you what, I'm glad that you're here because I've been looking for somebody that can get in the weeds with Ben, because he always tries to talk to me about this stuff. It's way over my head, and he just wants to get in there and, get all the minutia and all the detail. So I'm glad that you're here. I'm just going to sit over here. I might take a nap.
Pleasure.
You guys wake me up when this is over.
We'll keep it interesting. Yeah. We'll keep it interesting.
Yeah. You know what? When we said, like, you got to really break it down for that 10-year-old. That's really for my own benefit, right? So if you could just break that down, start as simple as you can about what options are exactly.
Sure.
So maybe do that.
Yeah, absolutely. So so they're often referred to as derivative instruments, which is really to explain that it's not the same as buying a stock or a bond. What you're doing instead is you're buying a contract that allows you to purchase a stock or a bond at a particular price on or before a particular date. So in the case of a call option, let's say on an equity position on a stock, it will have really two primary components. It will have the underlying strike price, so the price at which you are agreeing to purchase that security, and it will have an expiry date. So you have to be willing to purchase that security at that strike price, at that particular price, by that specific expiry date. And in the case of a put option, it's the opposite. It's the price that you're willing to sell the security at by a particular specific expiry date. And there's a premium, there's a cost to doing that type of business. And that is referred to as options premium. And the reason why it's become so popular to sort of that point you made earlier was because there's been a number of strategies that have been introduced in the last really decade that try and provide exposure to that asset class from the perspective of yield or enhancement or income enhancement for a portfolio. So that premium, if you will, can be often referred to as income enhancement or an alternative to, let's say, a dividend that you're receiving on a particular security. So if you're willing to sell options, for example, it's a form of income enhancement for a portfolio. And as a result of where we are in the economic cycle and where interest rates are, that particular use of options has made its way into sort of the mainstream and has increased the interest in the asset class. But of course, like most things, there's a lot more to it than just that. But certainly that's been, why it's on so many more investors' radar screen in the current period.
Yeah, so that point you make, obviously I want to go into a few more things, but a simple example, what you're describing, right, is you own, let's just say, shares of Bank of Nova Scotia. You want to generate some additional yield, you sell some calls against it. Is that what you're describing?
That's right. So if you have a position or you own shares in any particular security and you want to increase the amount of income that position or that investment is providing you, you can sell options as a way of collecting that income. And there's a cost to doing that, of course, as well. It means that you're either capping your upside or increasing your downside when you're doing that. But again, because of how low interest rates are, that opportunity to make some additional income is very attractive. The other side of that equation, of course, is you might be long, like you said, owning Bank of Nova Scotia, and you just want to protect yourself from a potential decline in that security. And in that case, you're buying options, you're investing in that premium, you're the one purchasing the premium. And in that case, it's almost like an insurance policy, quite frankly. It's you're paying something in order to protect against the potential or the chance of that position declining. And so in that case, that's owning options or owning put options. The alternative is, instead of owning Bank of Nova Scotia, you can buy a call option. And in that case, you're buying the potential, you're buying that potential upside. And so it really is an alternative way of getting exposure to underlying equities, as opposed to just buying the outright equity itself.
Yeah. So before we get too much in the weeds, I'd say maybe we can talk a little bit about the origins. Like, how did options start trading? How long have they traded in Montreal? Like, how has that been set up? Maybe just like, what was the original reason for putting this type of vehicle in place?
You know what? Like, it goes back a very long time. Back before there were official exchanges. I mean, we used to have almost just like brokerage houses that you could walk into off the street, almost like gambling, frankly. And instead of in a lot of those periods, instead of when you actually today, when you buy a security, when you buy a stock, you actually own that stock. Back in the days before there was structured exchanges and regulation, you could go into one of these stock trading houses, and it was really what was referred to as like a cash settlement. And so you never actually owned the stock. You were just really betting on the direction of that security. And that was the equivalent of options. And like everything in this business, as it's been institutionalized and people like yourselves, we all are licensed. There's regulation around this. You no longer can just do that. There's protections for investors today, and so there's established exchanges. And so the Montreal Exchange is obviously the established regulated exchange for trading those obligations. In the case of cash settlement or buying or selling these derivatives. So it's been around for hundreds of years, trading options. The Montreal Exchange itself has been around for over 150 years, and it actually owns some interests in exchanges in the U.S. as well. But it's a well-established asset class. It's been around for a long period of time.
Yeah, for sure. For sure. So who would, you have the Montreal Exchange, and then you'd have the individuals that transact and kind of make the market, we'll say, in the options market. Who would that typically be? Who would be the
Yeah.
one?
So 50% of the market in Canada is Bank of Montreal.
Okay.
They are the primary market maker in Canada for the derivatives exchange. The remaining market share is really split between Toronto Dominion Bank, CIBC, and National Bank for Canadian derivatives. That market share obviously it moves around over time, but Bank of Montreal and TD have tended to dominate that market. And I want to emphasize this point because it's a great question. In the U.S., for example, that market would be much more of a traditional agency-based market. For if I'm wanting to buy an option, there might be someone. You might be on the other side of that purchase as a seller of that option. In Canada,
Right.
that's really not the case. It's you're trading with the primary financial institutions in Canada that help establish that marketplace.
Yeah. Interesting. Does that make it a lot less liquid than
Yeah,
it would be in the U.S.? Yeah.
yeah, it's considerably less liquid in Canada.
Hmm.
But like anything in Canada, the Canadian banks tend to have a big role to play, and
Sure.
so they just like our equity exchanges, they're the primary market maker, and so
Yeah.
liquidity is really dependent on that counterparty relationship and
Yeah.
experience. So at Waypoint we've been in this market for a very long time, and as a result, liquidity isn't an issue for us. But certainly, if you're
Yeah.
an individual investor and you're on your online brokerage account, your ability to get fair pricing and liquidity in the options market is much more challenging.
Yeah, fair enough. Fair enough. So I guess a couple of points since you bring that up, I'd like to think around. So you decide you want to take a position in a security, then would you go and you'd call Bank of Montreal and say, "Here's what I want to do," or do they come to you when they have options that they need to trade, or
Uh,
how would that work?
Right. So it's a combination. It's both. So if we're looking to
Okay.
establish a particular, let's say we have we are long a bunch of equities and we want to just protect our investment.
Hmm.
We can call up our relationships on the derivatives desk at the Bank of Montreal, for example, and look to purchase protection for those securities, or purchase put options or different put option structures in order to protect that investment. But the other side occurs also. So in the case where the bank is looking to hedge or offset the risk that they might be taking on. So I'll give an example. If you have a
Yeah.
institutional client wanting to buy, like you said, 100,000 shares of Bank of Nova Scotia, and for whatever reason, the bank can't source 100,000 shares of Bank of Nova Scotia to sell to that client. Maybe they can only source 90,000 shares. So they have a choice. They can either take the risk of selling 10,000 shares additional and try and find a buyer down the road that they can take that they can take the shares from, or
Hmm.
alternatively they can go to their options desk and say, hey, why don't you give Ryan a call and see if he wants to buy some protection on Bank of Nova Scotia. By doing that, if they're buying me promises of being able to sell Bank of Nova Scotia at a certain price, theoretically that position is then an obligation for them to buy shares from me at a particular price. So they're synthetically long or owning that security at a particular price, which then allows them to take on the liability on their cash desk. So it's working with that within that dynamic. That is again very common in the options market, in order to generate that liquidity that you need in order to establish the positions.
Yeah. Yeah. Okay. Yeah, so I'd like to dig in a little bit in further on our conversation. Maybe you can tell me about how structured products play a role in the options market in Canada. But before we get to that, I'd like to kind of bring us back to the options. So I look at I think there's more to cover. But I look at, for example, Scott mentioned GameStop at the top of our conversation here,
Right.
and so I just want to give like a kind of a specific example here, and maybe you can walk me
Sure.
through kind of the thinking around it. But like you got GameStop closing at 256 today. They got options expiring tomorrow at a 260 strike, and they're trading at $13.35 still. So how would you kind of rationalize that, and like how does that kind of how does that balance? Why would people be doing that?
So, when it comes to so first of all, derivatives and options, generally speaking, had historically been an instrument really dedicated to the institutional investor community, because they are instruments that have embedded characteristics of leverage, and so although I'm exaggerating a bit here when I say this, but theoretically, depending on your investment, there's that risk of unlimited loss. The ability to lose all of your money when maybe that's certainly not your intention. And so, when you have, investors can gain exposure and get leverage through a number of different ways today. Options are probably the number one financial instrument where you can get the most leverage as an investor. So from a starting point, an investor that's really looking to speculate and take advantage of market behavior, almost like betting. You can use options as a way of really amplifying your returns. And so just as an example, if you wanted to buy an at the money, so a long position at the money, meaning that every penny that that whatever you were betting would go up, every penny would be a benefit to you if that security went up. You can do that today, at 50 times leverage in the options market. On index-related exposures, so that is why they're popular. That's the first reason. And again, not traditionally available to investors, but this has changed as financial instruments and online brokerages have really democratized access to these products. But when it comes to the specifics around what's happened with some of these very popular sort of investments that have taken place with the GameStops of the world. There's the options market is, like I said, it's a derivatives market. It requires a counterparty, meaning it requires if you're buying a promise to purchase or a security at a specific price, that means someone implicitly is selling you those rights. So if you have a right to buy GameStop at $260, it means someone has agreed to sell you GameStop at $260, and they have to estimate or price their risk to estimate is on that expiry date, like you said, tomorrow. What are the odds that GameStop will be $260? And that price right now, given where the stock closed at $256, is $13 or $16, whatever you said the premium was. And so some people who are selling that, the market is saying that within a high degree of probability, like within a 90% probability, GameStop will not go to $270 tomorrow, or not close at $270 tomorrow. The problem with this, of course, is we've seen in a number of circumstances people's inability to make those predictions accurately. So that pricing, that premium that people are paying, it's usually pretty sophisticated, meaning that over time, people who are selling these agreements or these options are why would they do that unless they were consistently making money? Unless it was their expectations of profit were always positive. So with any individual circumstance like a GameStop, Certainly, there can be exceptions to that, but generally speaking, those you have to just believe that these options are priced effectively. That the market maker, is doing it because they are generally making a small profit. GameStop is an example of where there is so much speculation on both sides. And so the people selling those options and those people buying those are both speculating. And so as a result of that, it's creating these dynamics in the market that's really impacting the implied risk that is being priced in these securities. So, this is always a chance. This can always occur in any instrument. It's just very rare. So, because of some of the popularity in this particular circumstance, it's a unique situation. But by no means is that the norm in the options market.
So what goes into pricing an option? So how do you go about assessing if it's priced appropriately? What are the inputs to price an option? Yeah.
So there are a number of inputs. But the primary one that everyone, that you need to have a good sense of is volatility. And, it's very hard to talk about volatility as a tangible thing. Like it's this mathematical sort of academic idea. But the simple way to think about it is really just, pick your period of time. So let's say you're buying a 30-day option. It is, if you were to look at every 30 days for that particular stock, it's how much does that stock tend to move up or down within 30-day periods. That is volatility. And so that is the primary factor that options investors are looking at. So, for example, if you had a stock that was $10 and every 30 days you would expect that stock to go up $1 or down $1. So within 30 days, every single time you looked at it, the stock was either $11 or $9. Then if you were selling an option on that security that was at the money, so the ability to buy or sell that security at $10, you would naturally want to begin pricing it at $1, because you'd want to make sure that if the stock typically did, went up $1 or down $1, you were not losing money as the seller, as the person making the market in that option. And so that is the primary factor that options investors focus on. There are some other factors around interest rates that also impact the pricing of options, but given where interest rates are today, it's really not that relevant. The number one factor is volatility, and that asset class, because it is an asset class, is one that has become very increasingly an area of interest for investors because of the way that you can use options to get explicit exposure to that concept of volatility. That is the primary factor that we focus on in this market.
Okay. Yeah, and as you say, each security has volatility. I think people generally understand market volatility, but each individual one has their own vol setup, right?
That's right. That's right.
Okay.
And again, this is a very numerical sort of academic mathematical thing. It's hard. It's not like you can't go out and go to your grocery store and buy volatility. You can't go into the stock market and buy volatility. But you can express the asset class using derivatives, using options. And going back to some of the concepts of protecting investors' capital or just the number of the tools available to investors today. Volatility has become an increasingly popular tool to accomplish certain objectives in an investor's portfolio.
Sure. Yeah, we've seen, at least last year, we saw a couple of the institutions kind of blow up on short volatility trades.
Yep. Yeah. That's right.
Yeah. So maybe you can say exactly what were they doing there? Like
Right.
obviously we saw Alberta blow up. What were they doing?
Yep. So the easiest way, the way to describe this, and is really to make the comparison to insurance companies. So in the belief, I mean, insurance companies, we all of us have automotive insurance, and the reason why we buy automotive insurance, obviously, is if we get into a car accident, we're protecting ourselves from the loss that could take place in an accident like that. And obviously, no one goes out every day looking to get into a car accident. So we pool our risk. And for those that are unfortunate to have that risk realized, they have that protection. And the insurance companies price our premiums such that the total collections of premium, the total premiums paid, are greater than the payments they have to make for people who get into car accidents. So that's how they make money. So the options market is generally perceived to be the same. It's the idea that you can buy these insurance policies or sell these insurance policies, knowing that, as a seller, for example, of these insurance policies, you're pricing them such that you're over any period of time you expect to make money. You expect to earn more premium than you'll have to pay out in profits. Unfortunately, unlike car accidents, for example, stock markets are not that predictable. Okay,
Right.
Whereas car accidents and natural disasters and all that actually are. There is a general statistical likelihood of these real world events occurring, whereas in the stock market that's not the case. They truly are unpredictable. And this is, we hear this from, the very beginnings of portfolio theory, of this idea of the market being a random walk. Some of your listeners might be familiar with that concept, this idea that it truly is random. And as a result of that, you can't ever, with the same degree of certainty, price derivatives as insurance policies. But because of that framework, that familiarity with insurance policies, people like in finance like to use tools and ideas that are familiar to them. Taking concepts from other areas of investment and finance and applying them to the equity markets and derivatives as a way of trying to model outcomes. And so, this concept that you're referring to is this idea that became very popular over the last real decade, called volatility risk premia strategies. This idea that we systematically price this premium to cover the losses. The same concept of the insurance world. We systematically price the insurance such that the losses are less than the sum of all the premiums we collect from our customers. And this belief became overwhelming in the institutional world, such that a number of institutions were systematically selling these options, selling these insurance policies, believing that they would not have an event that would result in them losing all their money effectively that they've been collecting. And of course, like everything, when something is too good to be true, it usually is. And we had a number of these events in the last really 3 years that really wiped out returns. So the first one that I'd point to is in Q4 of 2018, when we had that really big drop in the equity market suddenly on concerns of yield curve steepening. And then obviously, like, how often do people predict pandemics? I mean, you can't possibly say that was within anyone's purview. So when that occurred, the same thing. I mean, no one had that as a being priced into their insurance program. So naturally, you had a number of these sellers of insurance, these volatility risk premia strategies on the institutional world. They just weren't prepared for that, and they lost all their money. The interesting thing about these strategies And I think that the listeners will really appreciate this, because it's a psychological thing. So imagine, we like to present investment returns on a monthly basis. Very often we show 12 months of the year, we'll show 5 years of performance. And so when you think about selling premiums, when you think about the insurance approach, you're going to show maybe for 36 months slight positive returns, and you're going to have this beautiful matrix of 36 months of really nice small positive returns. And then suddenly in the 37th month you have this terrible negative result, and an investor looks at this and says, well, did I make money or not? Like, you can't, like, I have 36 months of positive and the one bad month of negative. Like, did I make money? And the answer is no. You didn't make money. But my God, when you look at 36 positive data points and one negative data point, it sure as hell looks like you made money. So these elements of how it's presented really gave, and fueled that confidence in these strategies. And so imagine it the other way. Imagine showing 36 months of slightly negative returns, buying these insurance policies. And then suddenly in the 37th month, you make a ton of money. And actually that money you made more than offset any of the small, the 36 months of losses. That's a lot harder to get investors to invest in. And, probably the person most, had been most commonly cited for this was Nassim Taleb and his Black Swan. He wrote a book called The Black Swan, and he always talked about these events that are never priced into markets properly, and he would sell these these programs. So it's just that psychological element that investors have become so accustomed to, of seeing that small little gain every month. And by the way, in the world of in the derivatives world, we call all strategies that look like that kind of return profile, make a little bit of money and then have a short period of losing everything. We call them short volatility strategies. There's really that this terminology, this vocabulary, it's becoming increasingly popular because of what's going on in equity markets and the popularity of this asset class.
Sure. Yeah, no, that's great. That's a good description. I can tell you. So as I've said, I run tail hedging. So I had that 2 years of grinding SPY puts and clients' portfolios, and then obviously an explosive return last February, which more than paid for itself.
Right.
That definitely is it's a classic example that people don't like to look at.
Right.
This is probably a good segue to tell me a little bit about how you construct a portfolio. Your return profile does look pretty similar to that you described, where you get your consistent returns. And maybe tell me a little bit about how you think about constructing a portfolio with the options overlay that you have.
Sure. So the unique element of what we just talked about, which is where I would emphasize to investors today, is that I can't say enough about how popular these short volatility strategies have become. This idea of trying to pick up premium as a yield enhancement strategy, and as a result of that dynamic, it has pushed the cost of this insurance, if you will, to record lows. And you can think about the setup, like, why is this taking place? I mean, look, interest rates are so low, bond yields are so low. It makes sense that people are looking for any other way to generate income. That is, there's demographic arguments for that. There's just general portfolio construction, reasons for that. But the truth is that there's a price, there's a fair value for everything. And when you have so much emphasis on that one direction of just trying to pick up that yield enhancement, as opposed to looking at the underlying value or risk associated with the instrument, you can get yourself into trouble. And so what's happened in the derivatives market in Canada is that those volatility risk premia strategies have just resulted in these insurance insurance policies being record low pricing. And so, and I'll really like to explain what I'm talking. So, normally, if you wanted to buy, if you wanted to protect your portfolio completely, let's say you had a typical portfolio exposed to the index, and you wanted to protect yourself. Typically, the cost of that protection would be 6 to 8% of the value of your portfolio. So you would, if it expired worthless, you would have lost 6 to 8% of your money. Okay. Going into, the pandemic, that cost was 2%. And, these are non-linear instruments. So yes. Like that significant, decline in the cost is, I can't emphasize it, like it's 10-year, decade plus the record lows. And so, sure. It didn't account for the risk. And so the ability to acquire those positions on their own. And I remember at that period of time, I was pretty much shouting from the rooftop, like anyone and everyone should just buy some because they are so cheap. But in particular, the way that we deal with it, it really sort of ties everything that I said together. So, we invest in an area the Canadian. We focus in Canada, and we invest in Canadian non-resource securities with an emphasis on companies that pay out dividends. And what we do is we take a piece of those dividends, and we buy these insurance policies. We get exposure to a long volatility strategy. And it's that dynamic. It's the combination of the fact that these policies, these instruments are trading near record low pricing, and the ability to pair it with a really proven investment approach in Canada focused on dividends. That produces a really unique return profile. It means that, in declining markets, or significant economic events like we've experienced, your options, your insurance policies are compensating or are covering any losses on your equities. The other element that's kind of interesting about it is it's tax efficient because you're able to take advantage of the gains and losses on these two instruments, which is very different than a balance mandate, where you're typically left with a tax consequence of selling your winner or buying your loser. Right. So that's in like a declining market. In a sideways market, obviously, you're trying to generate that dividend. You're generating that dividend yield on your underlying equity positions. Of course, you're trying to add some alpha by picking some good stocks, but you're also able to trade around that volatility that those option positions. And then in a rising market, you're doing your best to keep up with the market, but you're going to pay away some of your returns for those insurance policies, that protection. Now, this type of strategy in particular is very, is probably best deployed towards the end of a market's natural cycle. Especially in the period that we are in today, where valuations seem very high. Markets have produced excellent returns for investors over the last decade. There's a lot of red flags out there. This allows investors to remain exposed and invested in equity markets without that fear that they could wake up tomorrow and lose and see a big decline in the value of their portfolio. And let's not kid ourselves, for the buy and hold strategy, if you're 25 years old, buy and hold strategy makes tons of sense. When you're 65 years old, that buy and hold strategy starts looking a little more questionable, especially for those individuals that are living off their investments, RSPs or RIFs, where a decline in the value of their portfolio does truly impair the assets, because they are likely pulling out a little bit of money every month to pay for their lifestyle. And so you are going to realize losses. And so it is so important that one considers their cash flow requirements and the way that they're investing when they're thinking about deploying a strategy like this. This strategy or this concept, just like your tail hedges, really ensures that you don't need to worry about being precise about your timing on your investments. And when you're entering that retirement, when you're done with the idea that you're investing in the stock market and you think you're going to become very wealthy because you've invested in this, that most people that I speak to, when they've reached that point, they just want a reasonable rate of return that accommodates their lifestyle. And
Yeah.
these strategies ensure that you can do that. Traditionally, you could do that with a balance mandate, an equity and bond mandate. But today, with
Yeah.
interest rates and how richly valued bonds are, we're not seeing that being possible. In fact, when markets draw down, generally
Sure.
bonds sell off too. And so it
Yeah.
really, that ballast that you need in your portfolio really can be
Yeah.
achieved through these volatility strategies, as opposed to these more balanced mandates.
Okay. All right. So kind of what you're talking about here is you'd be owning the stock, buying protection via puts, or how would you structure it?
Yeah, so we're doing it a variety
Simplistic.
of ways.
Okay.
We're doing it a variety of ways, but in essence, we're long volatility biased. So we're owning
Okay.
these derivatives, but we do it in a number of different structures. So we look at put spreads, which is
Okay.
both owning and selling a put option with the same expiry. We'll look at risk reversals. So funding a put through selling a call. We'll look at taking advantage of calendar spreads by selling different expiries or buying different expiries of
Yeah.
options. But in essence, at the end of the day, we are buying options. And
Yeah.
the strategy isn't difficult necessarily to explain. It's hard to execute because of those
Yeah.
liquidity issues in Canada. So it isn't meant to be complicated in terms of its explanation.
Yeah.
It's
Yeah.
executing it that is the difficult part.
Sure. Sure. So, I guess most major pensions and institutions would have this kind of desk that'd be part of their structure. Is that
That's right.
that the case?
Yeah,
Yeah. Okay.
that's absolutely
Yeah.
the
So,
case. Yeah.
yeah. Yeah. So this is very unique from the perspective that it's an institutional strategy that can work into individual retail portfolios.
That's right, and I've been managing this type of strategy for institutional investors for my entire career, and it really has been because of the changes to the legislation around mutual funds in Canada that have allowed us to provide this for investors in more the retail client base. And so, through these new mutual fund rules, we can provide these same strategies to all investors. I'd emphasize in the U.S. there are a number of firms that offer these types of products for the
Mm-hmm.
U.S. Markets. In Canada, it's much different,
Yeah.
and again, it's because of the liquidity differences, the counterparty
Sure.
relationships in
Yeah.
Canada. So
Yeah.
it's really is meaningful to be able to do this in a
Yeah.
mutual fund structure, whereas
Yeah.
historically it hasn't been able to be done.
Sure. Sure. So one of the things I think we talked about at some point is, all the banks are coming out with these structured products, right? And
Right.
structured products, auto callables, principal protected notes, so on and so
Right.
forth. These are all structured with options, correct?
Correct.
Yeah. So as a result of when the banks want to put something in place, what happens? How would they structure these deals? Is this where some of the opportunities come from?
Yeah, no. So a lot of the requirements for the banks to hedge, so when they're selling these principal protected notes or these auto callables or any of these structured products, they take on a liability. Um, and in order to reduce their risk, they will try and offset that in the options market with investors that are basically positioned to take on the other side of that risk.
Hmm.
And so there's for a number of reasons. Um, those these structured products are very popular, and I don't I don't want to go into to provide too much opinion on them, other than saying
for
that
sure.
they're very lucrative products for the banks, and so
Yeah.
they have an incentive to provide them. And so, like anything, you don't. The banks have requirements to manage risk, and
Yeah.
so they naturally have to find counterparties to offload that risk too. And if if you have relationships with the banks, you can get very attractive pricing on that.
Yeah.
And so, we're one of the firms that the banks will come to try and hedge off some of that risk. And so, it just provides us, at the end of the day, our goal is always to reduce the cost of that insurance policy, or those options, as much as possible. And so we're able to do that because of the bank's requirements to reduce their exposure to these products.
Sure. Well, that's pretty interesting. I mean, I would think that you'd be in a unique offer, and you'd get to see a lot of deals, because I know there's a lot of deal flow happening.
Well, this stuff is on conveyor belt these days. Every month they're selling these notes, these structured products. So there's a pretty if you had the Montreal Exchange up in front of you, and you could see the monthly expiries of all the listed contracts, you could see that at the end of the month, at the end of the on that expiry date every month, you can see all the volume come into the market. So you'll have 28 days of very little volume, and then on the 29th day it's like tons of volume. So it's pretty systematic what's going on in the markets here, and as a result of that, like I said, they're just not efficient, and so for investors that are focused on this, there's real opportunity.
Okay, awesome, very interesting. I know you multiple times have said it's an easy strategy to discuss. I mean, I still think it is a little challenging for people to still kind of wrap their head around the simplicity of options. It is challenging to completely understand them. But I think you've done a good job of describing where the opportunities are, how they are, what kind of vehicles they are, and how they trade, and really how you execute. I think that sometimes when people hear options and volatility, it gets them scared. And so, I think as I look at your return profile, maybe you can talk about the fact that actually options reduce the volatility and actually can kind of make that your return profile smoother.
Yeah. So like I said, we like owning the protection. We like owning the policies. The options can be used as a risk enhancement in a portfolio, or a risk reduction tool in a portfolio. We use them as a risk reduction tool, specifically when there's drawdowns or significant declines in markets. Our ownership of options is offsetting those declines, is providing us with a very significant return to reduce the impact of declines in markets. And so for our strategy, what we do in essence is we're saying we're willing to give up a little bit of the upside, because we're concerned about the frequency of drawdowns that we've experienced in the last number of years. And when you look at that over the last, let's say 3 to 5 years, that exposure has resulted in pretty steady returns, irrespective of market direction. And again, given that, we certainly believe we're later in the market cycle, we actually expect these sort of, bouts of volatility to continue. And so having a strategy like this, where you're reducing the impacts of those periods of excessive volatility, is going to smooth out your returns. Of course, like we discussed earlier, people who look to enhance risk in their portfolios could use options in that regard. But for us, we're using them as a tool to reduce volatility. So again, it's best to think about them in the sort of the insurance sort of framework. You can either be the owner of the insurance or the seller of the insurance, and we're the owner. We're the owner of it.
Okay, awesome. That's great. So I guess last question for me, unless Scott has some, is, what's the setup like today? Seems like volatility's been coming down, so options are getting a little cheaper. What's the setup feel like to you today?
Yeah, I mean, the markets are, it's amazing what's happened in the last 12, 24 months. At the end of the day, this volatility we've experienced has only been increasing, not decreasing. And I think, people forget about that. Like, volatility works in both directions, up and down. And right now we're on the upside of volatility. And so for us, that gives us that opportunity again to buy the protection at exceptionally low prices, which is what we take advantage of. Our returns, in rising markets are certainly acceptable. It's, we just know that we like to, we like to hold on to those gains. And so we'll buy the protection in order to ensure that we're doing that. But the rise in equity markets generally is met with general investor confidence, which means people price in lower volatility or lower expectations of market drawdowns as that confidence builds, which allows us, to buy protection at cheap prices. So it's the same sort of dynamic that we've witnessed over the last number of years.
Awesome. Well, I think that's all of the questions that I have. Scott, did you have a few come along?
I just have one right here written down. What are options again? Could you just go over that for me? No, and what are if you could explain blockchain to me too while you're at it.
We're certainly in a unique time. There's no question. The complexity of financial markets seems to always be more, always be increasing. But the truth is that I think like sticking with first principles in investing is always the best place to start. And I'll quote the famous Warren Buffett or Charlie Munger. It's like rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And so that is the foundation of what we're doing when we're using options. It allows us to do exactly that, not lose money. And I think after the years that we've had of people seeing their wealth draw down 40% in a matter of weeks, I think there's more and more appreciation for that kind of thinking.
Absolutely. Absolutely. That's great. Awesome. Thanks, Ryan, so much. I really appreciate you taking all the time, explaining, answering all the questions you had. I think that's going to help a lot. All the viewers and listeners are going to appreciate all the conversation you have and have a better understanding for both speculating on options, but using options as a protection tool.
Great.
So awesome.
Thanks for having me, guys. I appreciate it.